One of the most important metrics in options trading is implied volatility. You need to be aware of the implied volatility of each and every underlying asset that you trade options on. The implied volatility tells you a lot. It tells you the potential range that that underlying asset is going to trade within. And because of the range, you can actually make better decisions when choosing strikes. Also, depending on the strategy you're using, for example, whether you're buying or selling options depends in large part on implied volatility. Is implied volatility really high? If it is, chances are you want to sell options in that case. If implied volatility is really low, chances are you'd prefer to buy options in that case. So today's topic is implied volatility, which we usually just call IV. And we're going to talk about how options traders use IV. So IV is a measurement of the expected volatility of the underlying asset's price over the life of the option. Basically, it tells us how far that underlying stock is going to move or is expected to move during the life of that option. So IV is a best guess measurement of the market's expectation of the potential range of the underlying stock's movement, and it plays a critical role in determining the value of the options we're trading. So as IV increases, the price of the option will tend to increase, all other factors being equal. As IV decreases, the price of an option decreases as well. Again, all other factors being equal. And that point is very important. When I talk about my advantage when it comes to trading options, I always talk about two big advantages when it comes to trading options. I talk about the time value of an option, theta, and I always talk about the volatility value of an option, which is vega. And because I like to sell options, time is always on my side, theta is always on my side, and also as long as I sell my options when implied volatility is high, when IV is high, it tends to come back down to earth. It tends to revert to its mean, to its average range. So if you sell your options when IV is high, IV will likely contract during the life of that option. And when IV comes down, when it decreases in value, then your option is also going to lose value, which as an option seller is a good thing. So as an option seller, you really want IV to be high when you sell your options. If you're an option seller, your premiums are going to be higher when IV is high, because when IV is high, you're taking on more risk selling those options. And when you take on more risk, you have to be paid more, right? When you take more risk, you get paid more to take that risk. For those of you using the wheel option strategy, which is my favorite option strategy, you're going to generally prefer higher IV because you're selling options, right? When you're running the wheel, most of your trades are going to be cash secured puts, which are short puts, right? When you sell a put, you want high IV. That should be one of the first things you check. When you go to sell a put, you find some underlying stock you want to sell a put on, check the IV. Is IV high or is IV low? If the IV is low, then chances are the premium for selling that put is not going to be very rich. In that case, you may want to find a different stock to trade. So let me go to my trading platform, TASTYTRADE, and let me show you where you can find IV on the TASTYTRADE platform. So in the watch list area, you can add IVX or IV index. That's the actual implied volatility percentage. So that is IVX. In the watch list, you can also find IV on any options chain. For example, on NVIDIA, if I go to the 57 DTE options chain, if I move my head out of the way, you can see at the top of each options chain on the top right, you have IVX, and you can see out to the side, IVX is 53.7%. So right now, NVIDIA has an IV of about 54%. So let's talk a little bit more about how IV affects prices. So if you want to see how IV affects options pricing, go open your trading platform and go find two different stocks. Find one stock that has a really low IV, whatever the number happens to be, and then go find another stock that has a really high IV compared to that first stock. Now that you have those two stocks, one has a really high IV, one has a really low IV, go to the 20 delta put for each of those stocks. You're going to notice something. The 20 delta put on the stock that has really low IV is not very far away from at the money. It's much closer to at the money. The premiums for it are going to be much lower, but the stock that has high IV, that 20 delta put, is going to be noticeably further from at the money. It's going to have a comfortable distance because the IV is the range, and the range is bigger if the IV is bigger. So that 20 delta put is going to be further out of the money. It's also going to be richer in premium. You're going to get paid more for selling that 20 delta put on a high IV stock compared to a low IV stock. And this is really why you want to sell options on stocks with high IV, is because you get paid more, you can get further out of the money, you know, you can get a little bit safer distance away from that at the money strike when you sell options on a stock with high IV. For example, since I've already got this NVIDIA options chain open, if I wanted to sell the 20 delta put, which I've already kind of got the 20 delta put, that position's already on, but let's imagine that I'm going to sell the 114 strike here. And I sell that, you can see I'm going to collect $3.30 on a buying power reduction of about $2,800. That's pretty good risk reward actually on that trade. But you can see right now NVIDIA is trading at 131 and my 20 delta put is all the way down at 114. That's a considerable distance away from where it's currently trading, right? Because IV in the stock is high. So I get paid more, I can get further out of the money, which means I'm a little bit safer, you know, where if this was a really low IV stock, and let's go find a low IV stock. So tech stocks typically have pretty high IV. I know financial stocks typically have pretty low IV. So let's take a look at BAC, Bank of America. Let's see what the IV in Bank of America currently is. If I go to the 57-day options chain, you can see its IV is only 25.5%. So about half of what NVIDIA's IV was. If I want to sell a 20 delta put here on Bank of America, I can go right here to the 37 strike. It's actually a 19 delta put, but it's the closest one I can get to 20. And you can see right now Bank of America is trading almost exactly $40 even, and a 20 delta put would be the 37 strike. So I can only go $3 really out of the money for that 20 delta put. That's not very far out of the money. That's not exactly safe, especially for a trade 57 DTE. I'm going to be in this trade for 2 months. What is the likelihood that this thing moves past $3, you know, decreases in value more than $3 in the next 2 months? Well, it's not, I mean, obviously it's a 19% chance, right? It's 19 deltas, but still, because IV is so low, you know, I would rather that 20 deltas actually be something like this, right? But right now it's so close, and you can see I'm getting no credit. I'm only receiving 39 cents credit for selling that 20 delta put. So would I be comfortable selling that put? No, this is not worth my time. I'm not receiving enough credit. I'm too close to at the money, right? So there's a good likelihood I could either lose on the trade if I realized the loss, or I'd have to accept assignment if I was running the wheel on something like Bank of America. There's just not enough premium in this. So I think you can start to see how implied volatility really affects options pricing. Let me go to Walmart, which I know Walmart typically has pretty low IV. It's not a great trading vehicle as far as selling options. Let's go to the 57 DTE cycle for Walmart. The IVX is 32%, not bad. The 20 delta option, there is no 20 delta option. I can only go 27 deltas or 7 deltas, but 27 deltas would be the closest to 20. But you can see I'm only, you know, right now Walmart's trading at 67.77, right? And I can only sell the 65 strike. That's like $2.77 out of the money on a 60-something dollars. You know, that's way too close, right? That is a dangerous kind of position to take on a short position, on a short options position, because the likelihood of that thing finishing in the money is pretty good, and I'm not getting paid much. You would think being that close to at the money, I would receive at least $1, maybe $1.50 for selling something like that. Certainly on a high IV tech stock, I would expect to receive well over $1 for this kind of position. But for Walmart, I'm only receiving 82 cents, right? So again, these low IV stocks, they're just not worth my time. So now that we've discussed IV, we should discuss IVR, because there's a couple of different IV metrics. There's your implied volatility, the actual IV, and then we have something called IV rank. And this is because the standard IV metric, the IVX that we just looked at on the TASTYTRADE platform, there is a big problem with that traditional IV metric. How can a trader look at the IV of one underlying and determine if that IV percentage is high or low compared to the typical IV in that underlying? And the answer is you can't, right? So when we were looking at NVIDIA's IV, its IV was 54%. Is that high or is that low? Well, how can you tell, right? Unless you're trading NVIDIA every day and paying attention to its IV every single day, there's really no way for you to just look at IV and say 54%, that's high for NVIDIA, or 54%, that's low for NVIDIA. You really don't know where its current IV falls in its normal range. In the slide here, I gave this example. If an underlying stock has an IV of 30%, is that high or low? Well, it all depends on the underlying, right? On some stocks, an IV of 30% could be on the high end of its range. On other stocks, an IV of 30% is going to be on the low end of its range. So you really have no way to determine if a stock's current IV is high or low or average for its typical range. And this is why IV rank was created, Implied Volatility Rank. So Implied Volatility Rank, or IVR, is a measure of the IV of an asset relative to its past IV values over the last year. So IVR is expressed as a percentage, and it usually ranges from 0 to 100, although sometimes you can get readings below 0 and above 100. There are special circumstances why that happens, but typically it's going to be from 0 to 100. IVR is calculated by dividing the current IV by the highest IV over the past 52 weeks, then multiplying that result by 100 to give you a percentage. The resulting value is IVR. And if you go to the TASTYTRADE platform, once again, IVR is found right here at the top. So when you get your ticker symbol right here, out to the side of it is IV rank. And the reason IV rank is the very first thing next to the ticker symbol here at the top of TASTYTRADE is because IV rank is probably the most important metric you need to pay attention to as an options trader. We've already talked about how implied volatility is the most important metric, but because implied volatility, you really can't gauge whether these IV numbers are high or low or typical for, in this case, Walmart. IV rank solves that problem because you can see IV rank for Walmart right now is 32. So is that high or low or in the middle of, Walmart's typical range? Well, 32 is a little on the low side, right? Because 50 would be dead even, right? And above 50 would be on the high end of its range. Below 50 would be a little lower on the low end of its range. And typically, when we're selling options, we would like 50 or above. Typically, but because right now we are in a very low IV environment in the market, everything kind of has low IV right now. You've got to lower your standards sometimes, and right now I'm lowering my standards to where, I actually think an IVR of 30 or above is pretty high, at least in this type of market. So right now I would consider Walmart with an IVR of 32 to be a pretty decent IVR. I would consider that high IVR. If I was an option seller, I would maybe take a look at selling an option. But again, IVR just tells you the rank. The actual implied volatility itself, the IVX here, again, even though IVR is high, I would say IVX of 35% is actually pretty low, because when you go to the options exchange and then try to sell an option, you see you're not receiving much credit, you're not getting very far out of the money. So they kind of work together, right? To get the whole picture, you have to look at both IV and IVR together, right? At first, I take a look at IVR. That's the very first thing I always take a look at. If IVR isn't at least 30 or above, I'm really not looking to sell options at that point, so I can just move on. But if it's 30 or above, then I have to investigate a little further. Then I take a look at the actual IV percentage, and then I take a look at the options chain and see how far out of the money I can get for selling something, between 16 and 30 deltas. And do I like the premiums? Do I like the risk reward on that trade? And if I don't, then I go find something else. Maybe I go find something with a little better IV rank. NVIDIA's IV rank is 58, which is very good, especially right now in a market where so many things don't have very good IVR. And we saw earlier when I went to the options chain with NVIDIA, I can sell quite a bit out of the money. I can go all the way to this 19 delta strike, which is 114. NVIDIA is currently trading 132 at this second. The markets are open. That's why the price keeps changing drastically on me. But that is a really nice trade. Like, I would be okay with that trade. Matter of fact, I am okay with that trade because I have almost that exact trade on as we speak. So now that we've talked a little bit about what IV is and about what IVR is, let's talk about IVR and the wheel strategy. As a wheel wheel trader, I'm always looking for higher IVR when I sell cash secured puts. I want an IVR above 30. Above 30 is acceptable, especially in a market like we're in now where the overall volatility of the market's kind of low. If we were in a higher volatility market, then I'd probably be looking for something with an IVR above 50. I think above 50 is actually outstanding, but above 30 is acceptable. Now, although I want high IVR, I have to be extremely careful when I see a stock that has a very high IVR. So something above 80, something that has an IVR of 80, 90, or even above 100. Such stocks are very volatile. That means they've made some huge moves recently, and they could make huge moves going forward, right? Because there could be some real momentum behind whatever big move it's made recently. So anything with extremely high IVR, you may not want to run the wheel on, because you could end up in a situation where it makes a big move against you. You end up with an assignment maybe you didn't want. And by the way, when I mentioned earlier that IVR is typically between 0 and 100, you can get IVR below 0. All you need to know, if there's an IVR below 0, meaning it's a negative number, that means that IVR right now is the lowest it's been in the past year, because it's below 0. There's no other reading higher than it. That's why it went into a negative number. So if you see a reading below 0, it's the lowest IVR in the past year. If you see a reading above 100, IVR is the highest it's been in the past year. That's why it went above that 100 mark. Now, getting back to cash secured puts, and especially with the wheel strategy, selling cash secured puts to start the wheel, there are two things I typically look for. The very first thing I look for is the underlying stock sufficiently liquid? If it doesn't have good liquidity, never trade it. Don't even think about trading anything that doesn't have really good liquidity. If it's liquid, then the next thing I move on to is, does it have reasonably high IVR so that my premiums are high? I'm not going to sell a put unless the premium I receive is something that I can live with, right? And there's no point in selling an option if the premium's really tiny, right? If I sell an option, I'm taking on risk. For me to take on that risk, I have to be paid at least a decent amount for taking on that risk. Now, when it comes to the back half of the wheel, which is when you're selling covered calls, I'm much less strict about needing high IVR to sell a covered call, because unlike with puts, puts you can pick and choose. When I'm selling my cash secured puts, I don't have to sell a cash secured put on any particular stock. I can actually go and find the ones with high IVR to get those rich premiums. With covered calls, you don't have that luxury of picking and choosing your stock. Typically, when you're selling covered calls, you already are assigned the shares of stock. You didn't have any choice of getting those shares. You already have the shares. You might as well go ahead and start selling covered calls immediately as soon as you get the shares. You can't just sit around and wait for IVR to spike up. You just don't have that kind of luxury. So with covered calls, just sell your covered calls. It really doesn't matter whether IVR is low or high. Although it would be nice if it was high. Again, you can't wait around for it. So just sell those covered calls as soon as you get assigned the stock. So let's talk about a little bit of IV expansion and IV contraction. So IV is a mean reverting asset. What this means is when implied volatility is higher than its normal range, it typically comes back to its normal range. If IV is really low for its range, it typically goes back up to its typical range, right? And so IV is a mean reverting asset, unlike price. Like a lot of people have this false conception that price is a mean reverting asset. Like, when a stock falls really hard, well, it's got to come back up, right? It's going to come back up because it's going to revert back to its normal range. That doesn't always happen. As a matter of fact, that doesn't happen a lot. When a stock falls, sometimes they just keep falling all the way to 0. That's normal sometimes for especially really garbage companies. But IV, unlike price, IV actually does mean revert. It has a typical range it likes to be in, and it tends to go there. So knowing this is one of the advantages of being an option seller, because when you sell something with high IV, it typically comes down to its normal range. That decrease in IV, which we call IV contraction, helps short options. It actually makes us money. IV contraction means our short options lose value, which allows us to then later buy back the options cheaper than we sold them to close. When you sell something at a high price and buy it back at a low price, that means you profit, you win. And on the other other hand, you should rarely sell options if the underlying IVR is on the low end of its range, especially if it's really low, like single digits, because then an IV expansion is likely. And when IV expands, that negatively impacts the price of short options. So those short options are going to start gaining value. And that, of course, causes you to lose money. And you can actually experience significant profits or losses solely from the expansion or contraction in IV when the underlying stock really doesn't even change price all that much. I have seen many times with my short puts and short calls where either the stock doesn't move or it actually moves correctly in my direction, and I still lose money because IV went up on my short options. And when IV, expands, my short options get punished. And I can actually show you an example of this. If I go back to the trading platform, I've got this short put in ARM, the 110 strike put here. And you can see ARM is trading at 160, 50 points above my 110 put. Actually, we're down $13 today. So ARM was actually trading 173 yesterday, $63 above my put that I put on 7 days ago. And if I go back to the chart here, so I put it on about 7 days ago. So say somewhere in the middle of this candle, probably there was a weekend in here. So, but the stock has gone, probably up at least $20 to $30 and it's pulled back, but it's still way up from where I originally put on the position, probably right around here. Well, you would think then my short put had to have increased in value because I've gotten the direction right. The stock has moved in the direction I needed. It's a bullish trade, and the stock overall in the last 7 days is up from where I put on the trade. But you know what else is up? If I go back to this chart, the bottom indicator here is the IVR indicator, the IV rank indicator. What has IV done in the last 7 days? Well, it's gone from about 23, 24, up to about 40, right? So IVR has really expanded. And of course, that's why I'm down on that position. So when you're monitoring your positions, if you notice that you're up or down big on a position, but the underlying stock hasn't really moved much, or maybe it even moved in your direction, but for whatever reason, you're still down on the position, you can bet that IV expansion or IV contraction is to blame. And of course, that's going to hurt you. IV expansion hurts you if you're short options. IV contraction hurts you if you're long options. So that was a quick overview of implied volatility as well as implied volatility rank. If you want to learn more about IV and IVR, check out my book, The Super Wheel Option Strategy, available on Amazon. It's about my favorite option strategy, the wheel strategy. And in a chapter of that book, I do cover a lot of very important options metrics, including IV, IVR, as well as I cover the 4 primary Greeks, delta, theta, gamma, vega. So check out that book. You'll find a link to it in the description below. Peace, guys.